I think we are going to kick it off with the final polling question of our session. Which of the following is expected, well, is expected to have the greatest impact on your company in 2020? Our selection is the business interest expense limitation, net operating loss, PPP loan, or the consolidated group split waiver election, or not sure. And we'll give that another couple seconds here. Folks a chance to answer. Okay, let's take a look. So it looks like the majority is the PPP loan. That is not surprising in the least. And, I guess the concentration on what that and the benefit of what that is doing for folks, and the continuing discussion of what more can Congress do to help is something that's actively being discussed. Speaking of politics, something that I wanted to start out with and touch on, I want to spend a little bit of time just talking about Biden's proposal, President-elect Biden's proposal. The changes that are looked at from a corporate income tax perspective. Let's just qualify this along with what everyone has said prior to me getting on. This is pure speculation. It's just something that I think we want to have in the back of our minds. There's a lot of uncertainty with respect to the political landscape. It's just worthwhile mentioning some of these ideas, because there is always the potential that any one of these ideas could become concrete and could become enacted in some form as the administration moves forward, and as there's some more certainty surrounding who actually sits in control of the Senate. I don't think it's a surprise that the corporate tax rate, there's thought around increasing it. An interesting concept was the new alternative minimum tax, which is actually based on financial reporting income that's greater, companies that have financial reporting income of greater than $100 million. Interesting is the thought around GILTI, which is currently set at 10.5%, because there's a 50% corresponding Section 250 deduction related to the GILTI income inclusion. Just as a refresher, GILTI is the total active income earned by a U.S. shareholder, U.S. shareholders' foreign affiliates, that exceeds 10% of the company's depreciable tangible property, which is, in other words, an exemption for qualified business asset investment, QBAI. One of Biden's proposals actually repeals that. In addition to doubling the GILTI tax rate, the other thought around that was to eliminate that particular exemption. There's a surtax that's being thought of around certain goods that are produced overseas and consumed in the U.S., which would bring the total tax rate on such production to 30.8%. This surtax could also apply to certain U.S. targeted services performed abroad, such as work provided by call centers in foreign countries, and a Made in America tax credit, which is the thought process is to offset 10% of investments geared towards creating jobs in the U.S., such as reopening, retooling, or expanding U.S. manufacturing facilities, and costs related to bringing overseas jobs into the U.S. to increase manufacturing wages. The interesting thing is that this credit would be advanceable, which is a fancy word for a taxpayer can claim it immediately upon incurring the expense, rather than waiting until the annual tax return has been filed to receive the benefit. Now, again, most of these things, I can't really imagine any of these things becoming legislated in its exact form as we see it, even though Biden has a history of making deals across the aisle. It's just something to be mindful of, something to be thoughtful of, that there may be a change to corporate tax law coming forward. Let's move on. Okay, so the corporate tax provisions in the CARES Act, it continues to be the most significant focus for our year-end tax planning. And the biggest piece of it that essentially has put the most cash back in taxpayers' hands are the net operating loss rules. So as we recall, under the Tax Cuts and Jobs Act, December 2017, the old 2-year carryback, 20-year carry forward rule became a no carryback, unlimited carry forward rule. And on top of that, added an 80% taxable income limitation to the utilization of NOLs. What the CARES Act did is for taxpayers generating the NOL, after 12/31/17, before 1/1/2021, a 5-year carryback was allowed. So that's significant because we're carrying back, if the taxpayer is in that position, is carrying back a loss from a 21% rate period back to a hopefully, back to a pre 2017, 12/31/17 period, during which there was a 34-35% corporate tax rate and recovering tax that was previously paid at a much higher rate. The 80% taxable income limitation was temporarily removed. The Act extended the Form 1139 eligibility to 18 months rather than the 12 months. This has been very helpful because that allows a lot of our clients, and this was particularly helpful in getting refunds for losses incurred in 2018, because we didn't have to file amended tax returns to claim net operating losses generated in 2018, but rather we could fax in Form 1139 in a much more expedited fashion. They gave it about a 90-day turnaround and recovered taxes previously paid. This just helped, taxpayers get their hands on cash much more quickly. An unexpected or unanticipated complication that came out of this is AMT, because the Tax Cuts and Jobs Act repealed corporate AMT for tax years beginning after 12/31/2017. And the complication is when you're carrying back an NOL under the CARES Act, the alternative tax NOL, the AMT NOL, that amount arising in a post-2017 year is treated as if it's zero, meaning you don't have an NOL for alternative minimum tax purposes for a corporation, which when you carry that back to an earlier tax year where there was alternative minimum tax, gives rise to a greater AMT. But this actually, what the guidance that we've been hearing, and in practice, this runs counter to current enacted authoritative guidance, which says that when there is an AMT enacted during a year which AMT is enacted and an NOL is being carried back to that year, a pro forma AMT NOL should be calculated. That's authoritative guidance. So we should be able to do that. The IRS has not yet promoted guidance on this, has not yet agreed with this. So at this point, it's not the law, but we would expect some further discussion about this as more and more taxpayers are taking advantage of an NOL carryback. There's also a little bit of uncertainty with respect to the recovery of that AMT. So if we're carrying back a loss in 2000 from a 2018, 19, or 20 tax year to a previous tax year where there was AMT, and because there is no AMT NOL to carry back to that earlier tax year, the carryback gives rise to AMT in that earlier tax year. Well, that reduces the amount of refund available to you in that earlier tax year, but creates an AMT credit that's carried forward. So how does one claim that AMT as a refund? Because the IRS FAQs that were issued over the summer, a little bit in the spring, and then later on clarified during the summer, expects taxpayers to be able to claim their AMT credits as a full refund on their Form 1139 to get that quick refund available to them and back in their hands. But what about the AMT that's generated by the loss claimed on that 1139? In practice, what we see is that that AMT credit that was given rise to by carrying back an NOL in an earlier tax year should be carried forward to the next tax return and not claimed on the 1139 faxed to the IRS. and claimed in that way. A couple of other things to mention surrounding the net operating loss under the CARES Act is thinking about the implications that carrying back an NOL has on that year's tax return, that earlier year's tax return, such as if the taxpayer had a Section 199 deduction, foreign tax credits, Section 965 installment payments, FDII, GILTI, and BEAT computations. Just there's interplay there, and one has to be mindful of that. One other thing that came up that was interesting with respect to the CARES Act was a consolidated group split waiver election that we left up in the polling question. And what that concept does is it allows an acquiring consolidated group to access its own carryback tax years while simultaneously preventing a carryback to taxpayer years of the new member, which would generate a refund payable to the original consolidated group. So that's not a desired outcome. If a acquiring consolidated group brings in a new member, we don't want to claim a refund for the selling group, the seller of the entity in its previous tax years, but it allows you to exclude that acquired entity from the carryback, preserve its NOL to carry forward with the new consolidated group. Finally, with respect to these net operating losses, just to touch on a couple of geographic states that surround this area, DC currently does not allow a carryback of NOL. Delaware allows a 5-year carryback. They cap it at $30,000 per carryback year. Maryland adopts the 5-year carryback provision. Virginia does not. Okay, let's flip to the next one. Let's grab the next slide. Great. Okay, so let's turn to some other changes impacting corporate taxation. We touched on a bit earlier that GILTIs, the total active income earned by U.S. shareholders' foreign affiliates, to the extent that it exceeds 10% of the company's depreciable tangible property. And so over the summer, the final regulations on GILTI came out, and one of the more notable highlights is it provides for an elective high tax income exclusion, which is known as the high tax exception. And what that does is it applies to gross tested income subject to foreign tax at an effective tax rate that's higher than 90% of the applicable highest U.S. tax rate imposed on a corporation, or 18.9%. So you do the math, it's 90% of the 21% corporate tax rate. And what that does is that income is not included currently when you qualify and elect the high tax exception. The income is not currently included in the U.S. tax base. And not only that, but it's likely eligible for the Section 245A DRD dividends received deduction when it's distributed. The high tax exception applies to each item of income for each tested unit of a CFC, noting that a CFC itself is considered a tested unit. Just to underline this, the elections apply to all CFCs owned by that controlling U.S. shareholder and to all of those CFCs' U.S. shareholders, meaning that you can't pick and choose. And it impacts other U.S. shareholders to the extent that they are a minority shareholder. Moving on to 163J. So part of the Tax Cuts and Jobs Act, some of us are familiar with the Section 163J business interest expense limitation, which limited the deduction for net business interest expense to 30% of adjusted taxable income. The CARES Act temporarily raised that limit from 30% to 50%. Let's note that this change can give rise to an NOL in 2020. It gave rise to, and a couple of examples that we had in our group, it gave rise to NOLs in 2019. And if it's carried back against pre-2018 taxable income, the tax benefit is recorded for financial reporting purposes because of the difference in tax rates. A special election is available to use 2019 adjusted taxable income for purposes of the 2020 163J business interest limitation. And this could also potentially give rise to a 2020 net operating loss, which can be carried back then to an earlier tax year with taxable income and obtain a refund. And the same result, if there's a difference in tax rates, a tax benefit is recorded for financial reporting purposes. There's also some recent final and proposed regulations around 163J. In the final regulations, there's a revised definition of interest, which includes things like original issue discount, qualified stated interest, certain swaps, and other amounts treated as interest, such as substitute interest payments and factoring income. The final regulations also included some anti-avoidance rules with a principal purpose test, which says essentially that if there's any expense or loss economically equivalent to interest, it's treated as interest expense if a principal purpose is to reduce the amount that otherwise would be interest expense. So what would that include? It would be an item that's deductible by a taxpayer. It's incurred by the taxpayer in a transaction or a series of integrated or related transactions in which the taxpayer secures the use of funds for a period, substantially incurred in consideration of the time value of money, and essentially something that is like these items and not otherwise defined as interest in the final regulations. Touching on the 2020 proposed regulations at a high level, slightly different than the 2018 proposed regulations around 163J. There's an election available under which a CFC, a controlled foreign corporation group, can calculate its section 163J limitation on a group basis, similar to the rules that are applicable to a US federal consolidated group, in which a CFC group is treated as a single taxpayer, and then each CFC is allocated its own share of section 163J limitation. The proposed regulations continue to exclude subpart F inclusions, guilty inclusions, and section 78 gross up from adjusted taxable income of a US shareholder. There is also a safe harbor election for CFCs that's a bit involved to get into at this point. It's revocable after 5 years, and it can't be made again until 5 years after revocation. We're also going to quickly touch on scheduling out of deferred tax liabilities and assets. When we look at some of the CARES Act changes, deferred tax assets and liabilities such as NOLs and 163J business interest limitation, that might be smaller. So when thinking about evaluation allowance, there are likely to be changes in the weighting of deferred tax assets and liabilities as we go through that analysis. We already touched on the fact that when you carry back an NOL, someone carrying back an NOL from a lower tax rate year to a higher tax rate year would record the recovery of taxes as a tax benefit in the year in which the NOL was generated. We do want to mention that carryover AMT credits should be classified as current taxes receivable as they become fully refundable. There was one interesting question that arose with respect to PPP loans. It was touched on earlier. Jim, I believe, mentioned it. With respect to PPP-related expense deductions that are expected to be forgiven. So IRS Notice 2020-32 says you don't get a federal income tax deduction for an expense that's otherwise deductible if the payment of the expense results in forgiveness of a PPP loan under the CARES Act. Now, the sense is that congressional intent was not to make PPP loans taxable, but without further guidance, that's the result. So when does one get to take a deduction for these expenses, if at all? When does the non-deductible treatment take place? Is it in the year in which the qualifying expenses are incurred, or the year in which the PPP loan is forgiven? When do they become non-deductible? And since the current rule follows IRS Notice 2020-32, and these expenses are not currently deductible, does that give rise to an uncertain income tax position for financial reporting purposes? I would say at this point, stay tuned. We expect more guidance. We expect to hear some more about this because, again, there's a conflict between what must have been congressional intent and practice that is taking place in current law. Let's just jump to the last slide and finish up. I think many of us are aware of the ability to defer payroll taxes. Many of our clients have been taking advantage of this. I think the new thing to add, since we did this at mid-year, is that due to Notice 2020-65, there's relief available to employers to defer payment of the employee portion of Social Security tax for wages starting September 1st, 2020 through December 31st, 2020, and that this becomes payable ratably between January 1, 2021 and April 30th, 2021. All deferred amounts have to be repaid in full by May 1st, 2021 to avoid interest and penalties. And that, in a nutshell, is what we're looking at from a corporate income tax perspective, from a year-end tax planning standpoint. Thank you, everyone, for listening, for joining, and hope everyone stays safe and well.